All right, welcome everybody to the Mark Perlberg CPA podcast. Super excited to be joined by Dale Willis. Dale is an experienced real estate developer who transitioned into real estate syndication and has developed more than 1,500 homes across 50 plus projects, totaling more than $500 million in project value. And we're going to talk about some of the things that he's doing and working on and tax strategies. And Dale, in your own words, why don't you introduce yourself in 60 seconds or less?
Yeah, you did a really great job, Mark. I've done real estate in some fashion for most of my life. I'm a hobby farmer, raising cattle. I've got a wife and 6 kids. We just started a real estate investment fund to allow people to be able to jump into the deals that we're doing. So we continue to develop land, build homes. We're predominantly in the upper Midwest, Minnesota, and the surrounding states, but we've just started some operations. We're doing a little bit in Southern California and Salt Lake City as well.
Awesome. Now, let's talk about this hobby for a second. Are you sure this is hobby and not a part-time business you got going on here?
Well, it's a part-time business that I probably lose money. I have so much fun, I don't really pay attention. We've got a small herd. We run 20 to 40 head of cattle, and we do the whole thing. We breed them and preg test them. And my son's a YouTube guy, and he did a whole video on it that was pretty fun the day that we were preg testing them and tagging their ears and cool. Giving them their shots, and it's a lot of fun.
Very cool. Very cool. And you're based out of Minnesota, right?
Yep. We're based in Minnesota.
All right, cool. Now we have a lot of folks that start off in maybe house flipping and, development areas, and we get a lot of newbies here. And one of the most common misperceptions that they have that I've had to explain to them is the concept of inventory. So we have guys, they'll build and develop a home and then they'll sell it. And they recognize $100,000 profit and they're so excited. And then they want to know, well, I have $100,000 of profit. I don't want to pay any taxes on it all. So why don't I just buy another house that I'll flip? See the challenge here.
Yeah.
So now they have $100,000 of taxable profit. They unload all their profits into another flip. And that they don't realize that flip, that new property is inventory that has capitalized, and you can't write off it until you have cost of goods sold. And at that point, you have more taxable profit. So when we're doing their returns now, the unfortunate thing is now they're wondering to themselves, we're hoping that they'd set some money aside for their taxes, but there is none because it's all of these all of these flips.
It's interesting you say that, Mark. It's a little bit different application, but doing real estate is a business. Buying a house and flipping it, you're self-employed. You're in business for yourself, and we see it all the time with trade contractors. Somebody that's new, they're really an excellent plumber or whatever the trade is. They say, I'm going to start my own business. They start that business, they make this money, and then they go out and they buy a new $80,000 truck. And now that money's not in the bank account, and they go buy all of these different de minimis assets, whatever they're trying to build their business up. And then they get their tax bill, and then all of a sudden it's like, well, I don't have any money. I had to spend it all. It's like, well, it's not exactly how it works. That $80,000 truck, depending on the year, but most of the times you can't expense that truck this year. You're depreciating it over the next 5. So we see it a lot. We'll watch really closely when we hire, because we love to work with newer companies and guys that are just trying to get going and establish themselves. We love it. But we'll watch them really closely, because when all of a sudden, we see 5 brand new trucks on the job site for this plumbing company that's new, we start getting a little nervous and start asking questions, because it's like, they often don't understand the tax consequences.
Yeah. And now let's say they are being resourceful and they're financing it. They're like, oh, this is great. All you got to put, a couple grand down, and now I get a big truck for $40,000 I'm going to write off. Well, you may not be able to use any of those, even if it qualifies for bonus depreciation, because you may be capped out at your your debt basis if you're an S corporation, then do you even need an S corporation? So there's all these other considerations here, which is why it's important to work with someone who's educating you. But let's talk about before we jump into, I'm interested to see your journey here, but I'm also interested to see, how did you learn about some of these foundational things and the tax consequences of developing property and the tracking of your inventory, building your accounting systems? How did you develop the systems and the understanding necessary for you to thrive?
Well, I think there's a couple of things. Probably the most raw, truthful answer is because I've screwed up before. I mean, that's, the guy that bought that $80,000 truck and then all of a sudden says, I have no money, but you need to write a check for $40,000 to the IRS. I've learned the hard way on some of these things, I think, but really it's surrounding yourself with really smart people that, saying, all right, Mark, you're my guy. Now tell me, how do I avoid these things? What are the pitfalls? And make sure, I think the principle of having the right who's around you is just so critical. And for me, that's where I've been really lucky is just, I don't know it. I don't know accounting. Now, I know a lot more about accounting than I used to just because I've been in the business. And so I think anybody that's getting started, it's a really tough balance because I'm starting to start my business. I'm going to flip houses, whatever it is I'm doing. And sometimes I don't want to spend the money to be able to go hire the experts. But at the same time, you can be out of business pretty quick when all of a sudden the IRS comes knocking because you owe them a big check and you don't have the money and you didn't have the experts around. And so I'd say that's probably the biggest key for me of learning it, is just having the right people around you that know. And there's a lot of value. I'm a huge believer in learning. The people that are watching or listening to this podcast, I think that's just critical to your growth, is constantly learning, because we're growing or we're shrinking, but I don't think we're stagnant. And so people that are listening to this fall in that category of they're learners. But I think that's the key, is just be a lifetime learner, constantly trying to find out new strategies and the best practices.
Yeah, so I see here, and we get a lot of people coming to us who are in the early stages of developing maybe their first or third or fifth project. And there's a lot of volatility we see when they're starting off as well. Things can go sideways. And a lot of them talk about getting to the level that you're at. So, where they can do $500 million a year, or whatever it is, tens of developments a year. What do you think is different about you, or what do you think are some key things that have allowed you to build at this type of scale? What are some things that maybe you're doing that other folks that are starting off or not doing as successful that makes a difference here?
Yeah, I think one of the biggest keys is a little bit of what I was just saying, is education. I can remember I was 21, 22 years old, and I was at a conference in Las Vegas, and I was working in banking at the time. And there's this guy, this would have been 93, and this guy claims that he was worth $1 million. So, I'm 21, 22 years old, and $1 million is like, wow, that's just mind blowing that he could be worth $1 million, because he was like 35 years old. And so for me, there's just non-comprehensible that you could be worth $1 million and 35 years old in 1993. That would just blew me away at the time. And he said a really important thing. He says, you've got to always be learning, always be reading. When I'm traveling, if I forgot to bring a book with me, I'll read the phone book. Now, keep this in context. This is 1993. And we don't have phone books, don't exist. And we also now have cell phones and other resources to learn. But the principle he said is, I'll open up the phone book and I'll read through the yellow pages. So for those that may not be aware, because yellow pages haven't existed for a long time, you have a phone book and your yellow pages were the sections that you could advertise your business. And so he'd go through the yellow pages and he would just learn about what's going on in that area and what kind of businesses were there. But what that instilled to me is, wow, if he could be worth $1 million at 35, what could I do if I keep learning? And so I've just been a sponge for information. One of the things I love to tell people is, especially young people, I love it when people come ask for advice because they're learners, they want to grow. And I'll say, I want you to envision in your head where you want to be 20 years from now. say, okay, now most of us all believe that we become the average of our peer group. So, okay, so tell me, Mark, where you want to be 20 years from now, how many people do you associate with on a regular basis, routinely talk to, associate with, that are where you want to be? And if they ever give me an answer that's 1 or 2, I say, well, your dreams aren't big enough. Unless it's your dad. Your dreams aren't big enough if you know anybody. Because the reality is, if you've got big dreams and aspirations, and you're in your 20s, you're in your 30s, 40s trying to get going, you generally don't have a whole bunch of friends or any friends that are where you want to be. So what do you do if you're going to be the average of your peer group? What do you do about that? That's a pretty tough proposal. And for me, you've got to do that through learning. Your peer group has to become podcasts. It's got to be reading books. It's got to be going to seminars. And I'm just a huge believer in that, of always growing. And eventually, when you get where you want to be, where that goal is, you will then have a peer group. But in the meantime, how do you create a peer group? And if you're going to be the average of them, if you got big dreams, it's impossible. And so I'm a huge believer in listening to podcasts, create your own peer group, read books, create your own peer group, constantly learn and grow. And I would say that's probably the biggest thing that is attributed to what I've done, is just that belief and philosophy of just never stop learning.
Yeah, I found that it's a progression on how you're going to access these minds that you really want to connect with. So you start off with the free, podcast and the YouTube and maybe some books. And I remember one of my favorite places to be when I was broke, getting things started, was the library. And then you may move into courses. And then you may move into paying for a coach, or maybe joining a network or having a group of colleagues. And then eventually you're around those people on a daily basis. And so you're just, as you embrace these things, you're gradually becoming more and more immersed with people at the highest level. And by the time you've gotten to the point where you're associating with those folks, you've all gone through the same path. You've all read the same books, pretty much, some of the foundational books, and are all talking the same lingo.
Yeah, that's a great principle I've never thought about. You got to start where you are. The library is a great resource. If I've got no money, well, how do I get access to this information? Well, the library, podcast, I think that's a really great principle that I've never thought about, is that progression.
And eventually you're talking to the authors of the books and getting direct feedback. And then you're getting the information. That's where you get lightning fast delivery of wisdom and knowledge to your brain as fast as possible when you're ready for it.
Yeah.
So tell us about, let's talk about the development side and then the syndication side. Tell us about maybe some of the wins that you've had, and also I'm interested to know, what do we expect coming down the pipeline in current environment of interest? These are really two different questions here, but what's coming down the pipeline, and what do we expect to see based on the current trends and interest rates and things that you're considering here?
Yeah, we've been really fortunate. We've had a lot of really great wins. We did, the market collapsed back in 2008. The market falls apart, and it's like, do you reach out and grab the falling knife yet? Is it going to hit the ground? And we worked really closely with a lot of banks. 2009, 10, 11, 12, 13, some of the best assets were owned by banks through REO. They had taken them back. And we had a scenario, we worked with a bank and they said, hey, you want to buy these assets? I'm like, not really. I already have my own problems. And we ended up meeting several times. And what ended up happening is we worked out a deal that we worked with them to work through those assets to help them. And it's really, as soon as you can figure out how to solve somebody's problem, that's when you've got a viable business. And we figured out how to solve the bank's problems. And as a result, banks, when they have REOs, they've got to write it down and they've got to set cash reserves aside. And once we figured that out, the Fed said, you don't need to set those cash reserves aside because these are now considered performing assets. And so we helped a bank solve their problem. Well, all of a sudden we solved their problem. We had multiple banks start reaching out to us and say, hey, can you do the same thing with us? Because that puts millions of dollars to our bottom line that we can't lend, that we can now suddenly lend if you solve our problem. So it was a lot of fun. It only lasted for a few years, but we worked through a lot of assets with a lot of banks, different assets that, if it was something that was partly under construction or something that was partly developed or houses. And, we had one group, we bought from a finance company that they had foreclosed on actually a lender. And then this finance company didn't know. We bought 450 different properties from them, and some of those one property turned into 120 houses that we developed, and some of them were just single properties, but that was probably our biggest win. And it really just came down to, you'll find what you're looking for. We were looking for opportunities. And so we found an opportunity. The second part of that question, what do we see coming? I think that's just so hard. I have no idea. I could say, what have we seen? What is experience? I've been doing this for over 30 years in some fashion. And so experience can teach us a lot, but the environment we're in today is entirely different than anything I've experienced in my lifetime. We had inflation back in the early 80s, but I didn't experience that. I was in middle school and high school, so I had no idea. And so it's really hard to say, but there's some things we get asked a lot on mortgage interest rates. Well, what's going to happen? We just use that as an example. When mortgage interest rates jump up on us, everybody paralyzes and they stop buying houses. They stop selling, they stop buying because what's going to happen next? And so you'll go through a lull. And then what happens is, if those rates stabilize, after about 3 months, people go, this is our new reality, and I'm now going to buy a house. And so, you'll see if they jump, you're going to see a pause, but then it'll stabilize. And now what happens if somebody's buying a house, as an example, they afforded $500,000 at the previous rate. Now they only afford $400,000. Well, then they're going to have to buy a cheaper house. If rates come back down, then all of a sudden we're going to see a big influx of buyers, which is problematic because if you look at every recession in the history of this country, housing is the first in and the first out every time. And so if we all of a sudden saw the interest rates right now that are jumping between 7 and 8%, if they all drop down to 4%, what's going to happen is that $400,000 house is now going to be $600,000. So you're still going to afford a lot less because we're going to see inflation go skyrocket on us. And so, it's a pretty tough challenge, but I'm a big believer in whatever's going on, there's always an opportunity. And so, look what you're trying to find. If you're looking for opportunities, you'll find them in any environment.
Yeah, you make a good point here, because I sometimes get some of our earlier stage investors say, hey, well, what do you see working for other people? Like, I don't know if I want to do this type of investing anymore. And, I think we're going to hold off on acquiring any more assets and just see how the market pans out. Those are only comments that we get from either people who are unprofitable or very inexperienced. The people who are in the trenches, have the experience, have a game plan, know how to drive profit, they're always closing deals. They're always pursuing. They're always growing and expanding. They don't wait for the time to be perfect. They don't wait for all the stars to align. They have a plan to acquire and grow and build when this happens, and when the extreme other side of the spectrum of this happens. They're always building and growing and developing and profiting. Maybe not as much some years than others, but they're always, there's no stop it. They're not, they're just adapting to each situation.
Yeah, it's interesting. I used interest rates as an example, just to what you just said. Interest rates, late 60s, interest rates jump up. So 1971, if you said, hey, I'm going to wait till interest rates go down, guess what? You didn't buy a house until 1993. Because it took till 93 before the rates went back down to what they were pre-1971. Well, how much appreciation did people that bought a house in 1971 get between 71 and 93? That was pretty significant. So they totally lost out because they were waiting for the right conditions. So I'm with you. You just got to find an opportunity, seize and go.
Yeah. And you have appreciation, equity pay down. And if you're going to manage these rentals, another thing that people don't remember to assign a value for is the experience you gain from just being in the game. Even if you break even, that's free education. It's better than what I had to drop on my bachelor's and master's degree to learn.
Yeah.
And when then the things are a little more favorable, and you'll be ready to profit when the time is right, instead of just putting on your training wheels because you were waiting for everything to be perfect.
Every deal I've done wasn't perfect. I've done deals that I've lost some money, but I think that's such an important principle you just taught is, that's part of the process. That's part of the learning and growing process. And, when you blow it, what do you do about it? You make the best of it and you say, I've learned, and now let's go.
So one of the things I'm wondering now is, one of the things we see with developers in particular is the greatest challenge is dealing with contractors and I'm sure you have your stories, because I've heard so many stories about contractors abandoning projects, overcharge, all sorts of craziness going on. And a lot of times people come into this thing not expecting it, and that just leaves such a sour taste in their mouths. And, it's hard for a lot of people to overcome. So how have you built so many properties and overcome the challenge of finding adequate contractors and people to support you on these projects?
That's a really good question. I mean, part of it comes with experience, and knowing who the guys are that are going to take care of you and not. Does that mean that we haven't had contractors walk off the job? No. But one of the things that we just firmly believe, we don't pay you till the job's done. And if a contractor needs me to pay him 50% upfront to start a job, that's often when people get hurt the worst. It's like, wait a minute. If you are so new and you are so cash poor right now that I need to pay you up front, we're probably not a good fit for each other. And often they'll say, well, I need it to be able to buy the materials. I'm like, so you're such a great credit risk that your supplier won't give you terms? Because most suppliers will give you terms. And so, if you've got to pay up front and your supplier's not going to give you 45, 60-day, 120-day terms, you've got a problem. And, if we got a bigger project, we'll do progress payments and we'll always do a retention. And so if it's a project that's going to take 8 months to build, well, most contractors can't float 8 months. So we say, okay, we'll do once a month progress payments. So a month is done, you're 10%. Okay, well, I'm going to give you 6 or 7 or 8% of that job, depending on what it is. 2 months are done, you're now 30% done. Okay, well, now I'll pay you 25%. It depends on the project, on how we'll do it. We have found that protects us because it keeps them on the job site. Mm-hmm. But if you're paying them too fast and early, that's when we see you get in the biggest trouble.
I found, and this is not just for contractors, but for any business owner, including myself, is accountability has to be, anytime you're paying someone, there has to be some form of expectations are mutually agreed upon, and there's some form of accountability, and that is monitored on a regular basis, because things can really blow up in your face. And also incentives. So perhaps, have you ever provided an incentive for them to finish the job on time or anything else like that by any chance?
Probably not the best advice I could give. We actually, in all of our agreements with our trades, we have penalties for not being on time.
That's an incentive. Don't get
I guess that's an incentive. It's not, I'll give you a bonus if you finish on time or early, but we do have penalties. If you don't do what you promised to do, there are penalties, because if the project takes me twice as long to get done, well, a house is probably the easiest way to do it. If we're building a house and let's say it takes 4 months to build, well, if you have terms with your contractors that are 45-day terms, well, you think about that. You're building a house in 4 months. The guys that were doing work at 2.5 months, you haven't even paid them yet when your house is done. And so the house is now finished. Well, at the 2.5 month mark, that means you haven't even paid half of your bills. Well, what does that do for your cash flow? So if you can close that house to your end buyer at 4 months and 1 day, you only needed half as much cash to build that same house as you would have if you were paying them the day that it was owed. And so if you think about that and you say, okay, well, if you had subs that are slow, that showed up on the job and they're slow, and now all of a sudden that job takes you 5 months, you do the math, and all of a sudden, instead of needing 50% of the cash to do that job, it could have gone up to 70%. And that could be the difference in making the deal work or not work, because now you had to borrow that much more money. You had that much more interest to carry that was on it. And so, speed to market's really critical. And that's why we'll tell our subs, if you don't abide by this, I'm not the one that showed up late. I'm not the one that failed what I committed to do. So therefore I shouldn't be paying the consequences. So you need to pay the consequences if you're not going to do what you promised.
Here's a story of the opposite happening in an unfortunate instance where a client was a little less experienced working with the contractor. So major project, multi-million-dollar rental, and it was short-term rental and seasonal, right? So the contractor takes way longer than he should. So now they miss out on renting the property during the busiest time of year. Major opportunity costs, over budget, taking way longer, and now he's out of money to pay back the contractor. So meanwhile, the owner has had a major loss because the contractor too long. Now he can't pay back the contractor with any earnings. And now the contractor is putting a lien on the house. And the contractor isn't even done with the work. So certainly there's a lot of value in structuring these relationships and setting expectations in the contracts to protect yourself and ensure that you're going to be profitable and sustainable.
Absolutely. Yeah. That's really where we'll see a lot of people get hung up is, you totally get this. This is what you do for a living. You're accounting and real estate. But, one of the keys is the language of business is accounting. And if you don't know that language, it's really hard to be successful. If I go visit Mexico, it's really hard to function if I know zero Spanish. Can I get by? Absolutely. But can I get by as enjoyable if I'm touring all over the country and going where people live and seeing them? Yeah, it's going to be really tough. And the same thing is, can I run a business not understanding some of these basic accounting principles? Absolutely, I can run a business, but it's a whole lot tougher. And if I understand the language of business, it makes it a lot easier. And just the principle you just taught just now, is a perfect example. You got to understand, what is the value of money? What are the delay costs, the opportunity costs?
Oh, yeah. Well, so now what I'm wondering is, what are some of the things that you're doing to mitigate your taxes?
We're in the best business in the world to mitigate taxes.
Oh, yeah.
I believe anybody that's making money and paying a very low tax bill are the best patriots we have. Because effectively, Congress has put in place certain mechanisms that say we need people to invest money in certain areas in our economy. And if we're investing in those areas, we're going to give you lower taxes. We're going to reward you for doing what you ask. And so when somebody figures out how to really lower their tax bill by making a lot of money, you're the best patriot, because that's exactly what Congress is asking us to do. Is they're saying, hey, we're going to incentivize you to pay less taxes because now you're investing in something that we need that's going to help our economies. Mm-hmm. And so when you can lower your tax bill, you're really doing exactly what Congress has asked us to do. Now, whether or not you like Congress or not, it's a totally different thing. But, being in real estate is the greatest vehicle. For a lot of the listeners that are listening that are getting going, you have a lot of episodes where you talk about this. And so I would encourage listeners, if you're not familiar with this podcast, go back in time and listen to some of those, because we don't want to jump into it here because you've got some experts that have talked about this. But if you're not a real estate professional, it's really hard to take advantage of some of the tax laws that are out there. And I'm a real estate professional, so I get all of the benefit of the bonus depreciations and all of these great things because my income comes from being in real estate. And so it's tough. We had, example, I paid 0 federal income taxes for several years in a row.
Awesome.
And it was fantastic. And a lot of it was through bonus depreciation and accelerated depreciation and, owning different assets. And we have in our company, one of the benefits that we provide a lot of our employees is they can buy a house. They can buy houses regularly at cost. So they might buy a house that's $400,000 and, they're buying it for $320,000 to $350,000, depending on the house and the circumstance. And I've got several of them that take advantage of this, and they buy them and turn them into rentals. And then they'll periodically sell a few, take their equity and buy another one. So they're reducing their debt. And it works really well. And we have a few that have really taken advantage and have built up quite a portfolio of properties. I'm talking to one of my employees and he's like, yeah, it sucks though. I don't get to take advantage of some of this depreciation. And I was like, that's right. This is horrible. You're paying all these taxes because he's in real estate because he works for me. That's what he does. But yet he doesn't get the advantages because he's not considered a real estate professional being a W-2 employee doing real estate.
No.
And so it's like, this is horrible. What do we do? And we actually, so we own a real estate equity company that people can invest in. And that's where it all started. Cause I'm like, this is totally unfair. You know, my employees, I want to help them build wealth the same way I'm getting to build wealth. And when we defer taxes, you can accelerate that wealth building a whole lot faster. And so we started looking into it. And that's actually was the catalyst of starting this real estate equity firm is because I wanted my employees to be able to build wealth. And so we said, well, why not offer that to anybody? But you know, one of the things our employees take advantage of is we have, as a company, we have a simple IRA. And so they invest in a simple IRA, is then we do matching funds. So whatever they invest up to a certain amount, we'll match it. And so that's all pre-tax money. We encourage them, depending on their circumstances, is convert that to a Roth IRA. And then they can take that, you know, and again, there's another episode you guys talk about, and I would encourage listeners, if you want to know more about it, watch these other episodes, but they take that and they put it into what we'll call a self-directed IRA. But it's basically where they can invest it into the real estate deals we're doing, and they're doing it as a Roth. So a Roth is, you know, they paid taxes on it already, but now when they take that money out, and we've run some scenarios that we have employees that can invest in deals that if they invest $100,000 from their IRA today, in 10 years, that IRA is worth over $1 million.
Wow.
And they keep compounding that, and they keep investing in their simple IRAs, or their, you know, depending on, you know, the average listener may not have access to a simple IRA, but if everybody has access to an IRA, everybody has access. So we teamed up with Equity Trust as an example. So people transfer it to them. Equity Trust then invested it in our project. And now all of a sudden they've got the ability, you know, I'm the worst investor in the world when it comes to stocks. You know, the old saying that the market can stay irrational longer than I can stay liquid is really true. And, you know, my IRAs every year until we came up with this plan, every year my IRAs were always, you know, 0 to a negative number in growth rate. Because I always thought I was so smart. And it's like, yeah, I'm just not a stock investor. I just don't know how to predict if Tesla's going to go up or down this week. And, you know, now it's like, oh, I could put them into real estate deals. And that's something we're doing, not necessarily a strategy just for me, because, you know, you are limited on how much IRA money you can invest at any given time. But that's something that we've offered up the employees, and it's working really great. But it's really a great vehicle. You know, but you know, the listeners that are saying, hey, I want to start building up, you know, initially it's tough. You got to start somewhere. But, you know, if you're working a full-time job and you're trying to flip houses on the side or do something on the side, well, until 50% of your income is from real estate, it's really tough to take advantage of it, but start somewhere. Go. You know, don't let perfect get in the way of progress.
Yeah, some other opportunities here. So let's say, you know, you're restricted because you got to own at least 2% of the business to get rep status. You could consider, now this might be, and this may not work, and it probably doesn't because then you lose your benefits, but you could have made him a contractor. Then he could be rep as a sole prop, or you could have his wife get rep status, or you can invest in short-term rentals, which doesn't require rep status. But those ideas may not work for him.
Those are good ideas, though. Worth looking at. I like that, Mark. That's really good advice.
Yeah, the wife one is a good one. So I mean, we explore these things and see what makes sense for the client. Sometimes they get really excited and then they realize, well, like my wife would be a horrible landlord, or you know, she's too busy raising the kids or whatever. But it's interesting to see that. And then obviously the short-term rental thing, which is everybody's jumping on now with 7 days or less as a workaround for the rep status, is really neat. But even if you don't have that, there's still so much advantages in having tax advantage real estate inside of that's offset by the depreciation and using leverage. So there's still so much cool stuff out there, even if you don't create losses that you can use.
That's it. Those are really good ideas. I love that. I'm going to share that with some of our team.
Yeah. Or you could have a pig. So you invest in oil and gas or something, other sources of passive income that use those passive losses. We rarely see it, but we get it every now and then. So what I'm wondering is, so you're doing syndications now. Can you break down the numbers of what kind of profits are you expecting and are you seeing, and what kind of projects are you working on?
So we decided, so we're fairly new to this. We've been really, really fortunate. We've used internal cash to do all of our deals. And then it was 2 years ago that I'm like, how do we help our employees create wealth? And that's where it's like the syndications ultimately came about. And so our initial offerings that we have right now is we're offering that somebody can invest in our real estate development and housing. So example, we have a deal that it's a phase 2. We did phase 1 with all of our own cash, and we built, I think it was 40 houses. We sold them all. We know exactly what's going on. And I said, okay, so for these early ones, let's just replicate what we're already doing. So we can say with a lot of confidence that this is a really good investment because we invest in this every day, all of my money. And so we said, all right, well, let's just take phase 2. It's another 39 lots, and we're going to build those. And we already own the land. And so we're about to start putting the development, put the lot, the streets in, the street lights kind of things. And then we'll build and sell 39 houses. And as that one is an example, based on historicals, we're forecasting a 17.9 IRR. And that's one that, somebody just writes a check, minimum 100,000 investment, or if they wanted to do it with their IRA, they can do a minimum 100,000 through the IRA. Somebody can go to Centra capitalpartners.com and they can see all the information, but that's an example of one. So we've got 2 of those. Eventually we'll start offering up, we do some work in apartment deals, some small commercial, and eventually we'll start offering those that people can invest with those. But initially we're doing the for sale housing subdivisions are the ones that we're offering up. There's a huge need for housing, and we're predominantly in entry level. And the thing I love about the fact that we're in entry level is, it's like a big funnel. There's this many people that can afford a $300,000 house, and there's this many that can afford 400, and this many at 500. Well, we're at the entry of that funnel. And so when rates go up, that funnel shrinks suddenly on the number of people that can afford 300,000. And, we all see it that there's a huge supply issue on housing nationwide. And so being at the entry of that funnel puts us in a really pretty great position. And so that's why we decided, let's do that, give people opportunity to invest with us, co-invest with us in these projects. And so we're just doing the housing right now because it's just a solid investment. And I want people to have an amazing experience. And so we said, well, let's put together these initial ones that are going to give a fantastic experience for people.
Wonderful, wonderful. And do you have any gigantic, scary, monstrous goals or dream projects you think you might want to do in the future? Anything you're thinking about?
Yeah, I always have big, monster, scary goals. We're right now working on embarking. We brought on a whole bunch of new talent on the team. So we just stole away a guy. He's now the president of Centra Companies. He happens to be my brother, but he was responsible for $1 billion+ of new construction job sites all over North, Central, South America, and the African continent. That he'd have anywhere from $1 billion to $1.5 billion under construction that he managed. And so we brought him in with some strategic goals. We just hired the senior VP of finance for Buffalo Wild Wings. He helped Buffalo Wild Wings go from 100 units to 1,200 franchises across the world. We brought him in as our CFO. We just hired another guy that's been a real estate attorney for the last 15, 20 years. And so we're bringing in the right people, with the next phase being is we're really, really good at real estate. We know what we're doing. And now let's bring in that expert talent that's going to help us go nationwide. And so, we're now doing deals, we're in all over Minnesota. but now we're, putting offices in Salt Lake City and Los Angeles and looking at deals in Florida. And so we're looking at, we're really good at what we do and we love it and we know it and we're passionate about it. Well, there's no reason we need to be limited to just a small footprint. And so that's really the big push is let's grow this thing all over and give the opportunity for a lot more people to be able to grow wealth with us. And so we're really excited about the next phase in life.
Awesome. What do you do for fun or for enjoyment when you're not at work?
We talked about this at the beginning. I love farming. As a kid, I used to dream about having a cattle ranch. And I can remember I would sit on the grass under a shade tree and I would just sit and dream about this being a cattle ranch and riding my horse and checking on my cattle. And it's funny, I had this vision of a long driveway to my house and it's tree line and grass on either side. And frequently I drive home and I go, I'm living the dream. And
wow.
One day my wife's with me. She goes, what do you mean you're living the dream? And I said, this is exactly what I dreamed of as a kid. I'm living the dream. This is the dream I had. I don't want to be a full-time rancher, but I got a cattle herd and I've got a 1/4 mile long driveway with trees lined down either side with beautiful green grass to get to my home. And so I'm literally living the dream. And I just love farming. I love the cattle. There's a few other things. I love snow skiing and water skiing and riding my Harley and all kinds of other things. If it's outside, I'm there. Let's go. We'll have fun. But I just really love having a cattle ranch. It's a passion, and I love coming home and living the dream.
Yeah, I used to dream that I could do stunts on a motorcycle like Evel Knievel. I don't really dream that anymore. I'm like,
it's funny how our dreams change as we mature and get older, huh?
Yeah. Now, so is there anything, so for the people listening who may be interested in learning more about your projects, investing in what you do or learning about what you're doing, where are some places people can go?
If they go to Centra Capital Partners with a C, .com, there's a whole bunch of information. They can see the projects that we're currently offering. They can see the business models on how they perform, where they're at, all kinds of information. So there's a ton of information there, and that's a great resource if people have some interest in co-investing with us.
Cool. Awesome. Well, hey, Dale, thank you so much for your time. And for those of you listening, if you want to learn more, you got his info. And if you want to be a client or someone who could join the team, go to markperlbergcpa.com and we will talk soon. Have a great day. Thank you so much, Dale.
Thanks, Mark. Appreciate you.